very respected speaker of this evening, CA Rajesh Kumar from Bangalore, my council colleague and chairman of the committee on GST, CA Pampana from Bangalore, secretary of SIRC, CA Panaraj from Bellary, senior members, friends, very good evening to all of you. It gives me a great satisfaction to once again join with you this evening for the second day of a refresher course on GST. Though government of Karnataka announced lockdown for the state, today 75% of the screen occupied by our Karnataka team. Irrespective of the pandemic and irrespective of lockdown, our professional colleagues are working for the betterment of the profession, council members and speakers as well. Thank you so much, sirs. On behalf of SIRC ICAI, I welcome the great speaker of this evening and I express my sincere thanks to our learned resource person, CA Rajesh Kumar, for immediately accepting our request and share his wisdom amongst our elite professional gathering. In fact, a few days back only, we have requested him to speak for today's program. Thank you so much, sir, for immediately accepting for our invitation and the support to SIRC. I welcome CA Pampana to this GST program. I also thank you for coordinating this program. I also welcome each one of the members who are all participating this evening program, and I deem it my pleasant duty of offer my hearty thanks to the members who support by their active participation to our programs has been instilling confidence. I am sure the exposure that the participants will get on the subject of presentation by the speaker of eminence and his expertise will broadly update our understanding on the impact of Finance Act 2021 and other recent developments with respect to GST. With this, I request CA Pampana to introduce the speaker of this evening to the viewers.
Thank you, Chairman. Chairman Jalapati sir and Secretary Panara sir and today's young and dynamic speaker CA Rajesh Kumar TR sir. Good evening, members. Today is the second day of the virtual program refresher course on GST, and I, being a GST committee chairman, chairman has given a free hand to conduct many programs on GST, and now we are coming up with so many programs which is lined up in the coming months, which is a knowledge updation on GST. And I, CA Rajesh Kumar TR is also a co-opted member of GST committee. I requested him to have many programs on GST to coordinate him and bring across all the expertise from the countries, different parts of India, to update the knowledge on the members. During this pandemic, our chairman is working so effortlessly to update the knowledge, dissemination of knowledge to the members. Thank you, Chairman, for your tireless efforts for the members. And once again, I welcome each one of you for the 2 days refresher course on GST. And today, it's my proud privilege to introduce today's speaker, Rajesh Kumar TR. He's a chartered accountant by profession, and he has also done LLB and completed his schooling and graduation and articleship from Tumkur, and later moved on to Bangalore. And he's a presently practicing chartered accountant in the area of indirect taxes at Bangalore. And he was an earlier senior partner at Hiragange and Associate Chartered Accountant firm with a good repute in the field of indirect taxes for more than 17 years. Has written many articles on the central excise, service tax, VAT and GST for various professional journals, and presented number of papers in the various seminars and workshops. And he has also authored number of books on the goods and service tax, central excise, service tax, KVAT as an author, joint author as well as assisting author. To name some of the books: Handbook on Annual Returns and GST Audit, GST Ready Rector and GST Tariff, Practical Guide to Service Tax, Central Excise Made Simple, Central Excise Law and Procedure, and KVAT Audit Manual. And he has also contributed substantially for the compilation and the revision of study material on the indirect taxes published by ICAI for CA final students. He has also contributed for background materials on GST and UAE VAT published by ICAI. He has been a faculty for different programs conducted by ICAI addressing members. He is also invited as a guest faculty at the colleges to address the students. And he is always a great supportive to the ICAI. And today's program is also just immediately has accepted our invite, as Shankar Narayan sir has been tested positive COVID, and due to which immediately we called him and he has accepted our invite. Thank you, Rajesh sir, for your immediate acceptance of as a speaker for today's program. Without your support, this program would not happen. Thank you, sir, for wholehearted support for ICAI. And members coming to programs from the GST committee, we will be line up many programs on the recent developments in the GST. We are just planning, and which will be published in the newsletter in the coming days. And please follow up with the ICRC website for the more updates on the GST committees. Thank you. With this brief introduction, I present you before CA Rajesh Kumar TR to August gathering. Thank you.
Over to you, sir. You can proceed.
Okay. I think at the outset, I would like to thank SIRC, office bearers, and the entire team for giving me this wonderful opportunity. Though I'm coming as a substitute player, I'll do my best for the scoring the runs for the team, SIRC. The topic which is given to me is the impact of the Finance Act 2021 in the context of the GST law, and also the recent changes. Though the finance bill was initially presented and has become act, essentially my focus would be more on the impact of Finance Act 2021, with some of the aspects of changes also I'll be covering. But any member, any participants who has any questions or queries on whatever I'll be discussing, or any other aspects related to changes, can post their questions or queries in the chat section. I think probably at the end, I will leave some time to address those things, which will try to address all the questions possibly at the end of the session, subject to time availability. I think before I start, I would once again thank the chairman, the secretary, as well as the GST committee chairman, all the other office bearers of the SIRC for giving this opportunity. Hopefully, I think my screen is being visible, sir.
Yes,
yeah.
sir. Yes, visible, sir. You can continue.
Yeah. So I'm just going to start my presentation with that. The coverage, as I mentioned, I'm planning to cover the GST impact of Finance Act 2021 and recent changes in the GST law. The first changes which is to be dealt is the amendment to provisions of Section 7. Before I go into this, the sections which are covering these amendments are starting from Section 108 of the Finance Act 2021 up to Section 123 of the Finance Act 2021. Out of that, Section 108 up to 122 is dealing with changes regarding the CGST Act, and 123 is dealing with the changes relating to IGST Act. Now, though this finance bill has become a finance act, in fact, a couple of provisions contained therein is effective retrospectively from 1st July 2017. Still, that has not been made effective because Section 1 subsection 2 Section 2 subsection 2 of the Finance Act says Section 108 to 123 shall be effective from the date, the appointed date. So whereby, though it has become a Finance Act, still now these provisions have not been made effective. It will be effective from the date which will be notified as an appointed date. So this is still a provision to become effective, though it is there in the statute book. So this is very important to note, because certain aspects of which, when we will be dealing with certain aspects we're discussing, we have to be aware of this fact. So none of these provisions are effective as on date. So coming into the first amendment which I am going to deal is the amendment to section 7.1. The 7.1 gives a start, rather to say, scope of supply. Unlike a definition of supply, it is called a scope of supply, where it has its own importance in saying so. I'm not getting into that discussion, but the opening sentence of the said section 7.1 is relevant for us to further discuss upon the impact of the changes which is proposed, or rather implemented, to be implemented, is like this, which is visible on the screen. For the purpose of this act, which is also equally applicable for IGST Act, the expression supply includes, what is intended to be added is AA, that is the activities or transactions. I stop at this point in time. Whereas we are not, unlike in 7.1A, we are talking about includes all forms of supply. Here it is talking about an activities or a transaction or transactions. Now, what difference does it make? Is it so important to look at the forms of supply like sale, barter, exchange, etc., as against here the activities or transactions? The term activities or transactions are much wider as compared to, though I cannot say a comparison, but still the terms are very wider to cover various aspects. But it is at the same time difficult to freeze out or to say what it intends to cover, because activities is such a wide terminology. At the same time, transaction is also very wide terminology, whereas in what context they are using here is not so clearly forthcoming. Nevertheless, some things we can deduce by virtue of an explanation, which is again going to create some more confusion. I'll go to that little later. Now it is talking about activities or transaction by a person other than an individual. So though we all know the purpose of this explanation was essentially to cover the transactions which the Honorable Supreme Court in case of Calcutta Club held that when the club and association and its members are carrying out any activities, there cannot be any service between them. Though they're merely a representative capacity, they're acting like an agent, so there cannot be a tax for the transaction intersect between them. That was a decision of Honorable Supreme Court. They applied the concept of mutuality over there as well. In fact, they said even the incorporated entities, still between an incorporated entity and its members, whatever the transaction being entered would not constitute a supply. I mean, rather a service was the decision. To overcome this, the decision in the GST law, they did not wanted that decision of Honorable Supreme Court to affect on the collection of taxes under the GST law. So they wanted to bring in a changes retrospectively. Okay, let's keep that aside. They wanted to cover that aspect. This is also clearly forthcoming from the council meeting. But whereas the way the provision is worded is much more different and wider. So we have to be careful on that. And in my understanding, this provisions may go out for challenge because I expect the innovative interpretation which may be coming out of this may lead to various other consequences. Like, for example, when it's talking about other than individual, it covers a partnership firm, LLP, in addition to association of person, body of individual, etc. So whether this amendment is intended to cover those also, or it's only confined to clubs and association, is what we need to see. It is talking about activities and transaction by a person to its members. If it was members, obviously would have assumed that it is generally connected with the word body corporates. It further talks about a constituents. So what is the term constituents mean? Constituents generally, as per the understanding, anything which a object or a subject is made out of. So similarly, if we go in such a wide connotation, a partnership is made out of a partners. So the partners may be said to be a constituents. Similarly, the who are the members of IOP can be called as constituents. The members of a HUF can be called as constituents of HUF. So there may be a lot of issues which may crop up, but in my view, it is clear that this provision has to be interpreted the way and the purpose for which it was brought in, as guided by the minutes of the GST Council. So reading down the provisions, in my understanding, they should be only applied to a clubs and association and cannot be applied to any other aspects, though they are cautiously worded to overcome any type of adventurous interpretation and later on going to courts and defending the other transactions. They have been very cautious in drafting it. So in my understanding, though it is so widely worded, it has to be confined only to such of the transactions, incorporated, unincorporated, association of persons or body of individuals or clubs, or in societies for its members only are intended over here. Now, there is also a possibility that the joint ventures who are unregistered in associations may also fall into it, because generally the constituent words are used in the context of joint ventures. So we need to be very careful over that. In case of a joint ventures, I see a lot of impact over there with this amendment. Also there was one service tax clarification which was given in the restwhile law, where it says that where a joint venture is formulated and who are the member of that particular joint venture is carrying out certain activities, the joint venture is treated as a separate person different from that of a member. Thereby there's a supply interest between them. So I think keeping that in mind, I'm seeing a lot of issues which may get created in joint ventures. We need to be very cautious on that. Now, I've highlighted in this changes the words for cash, deferred payment, or other valuable consideration, as compared to the clause 7(1)(a), where it is essentially envisaging two important aspects to be there. One is a consideration and other is a business. Whereas the proposed amendment is not talking about the aspect of business. So these activities may be called as for the purpose of business or not. So they are intending to cover all the activities and transactions, whether it is in the course of business or not in the course of business. So that one important thing which we note. Why I've highlighted these words for cash, deferred payment, or other valuable consideration is, if we go back to the jurisprudence under the sales tax law, where the similar words were used, there are decisions to say the word other valuable consideration to be read ejusdem generis with cash and deferred payment. It cannot include the non-monetary aspects of it, which is in the nature of barter. The other valuable consideration should be in line or in the similar aspects like check, demand draft, those type of documents, and cannot include other barter transactions, is what some of the precedences say in the context of VAT law. We can examine whether those can be applied in the context of this amended provision. Why? Because if there's any activity which is not in the monetary form, which are in the non-monetary form, cannot be said to be covered here. This can be also substantiated with the fact that as compared to 7.1a, which it's using a word consideration, whereas 7.1a is specifically using the different connotation like cash, deferred payment, other valuable consideration. So I think if it was to cover just like monetary or non-monetary, they would have simply used for consideration as is used in 7.1a. Since they have intentionally use different wordings, we can always try to say the principle of barter, not to tax barter transaction like a VAT law, judicial prisons can be tested under this also. This is what is my I'm seeing the impact of this. Now coming to the explanation over here, I would like to read this. For the purpose of this clause, it is clarified that notwithstanding anything contained in any law for the timing in force or any judgment, decree or order of any court, tribunal, authority, the person and its members or a constituents shall be deemed to be two separate persons. Till now it's fine. We have no difficulties. The next part is something which in my view is not rightly worded. And the supply of activities and transactions. See, we do not supply an activity, we do not supply a transaction. The activities and transaction are considered as supply. But here the wording supply of activities, supply of transactions gives a different connotation altogether. So we may have to, if we have to read it, give a purposive interpretation, harmonious construction, then in my understanding, the term supply has to be read down, and it has to be read down only as activities and transaction into say shall be deemed to take place from one such person to another. So I think here this is what I just wanted to highlight. The wordings of supply of probably is not a proper wordings over here in the explanation. Now coming back to the aspect of what was there in the definition of already there, the what was lacking to tax it, why with this amendment came in. If I have to see, 7.1a covered all forms of supply of goods or services of both, etc., 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 made for a consideration by a person in the course or furtherance of business. So a supply is made for a consideration by a person in the course. So always it required two things. One, the supply for a consideration. Second, it should be in the course of business. The Honorable Supreme Court essentially said in cases where the mutuality principle applies, the entity which is acting for its members is nothing but doing it in the representative capacity. It is not an independent transaction between them. It is between them as a one person to outsider, or from an outsider together constitute one person. So there is no two separate person between the entity and its members. That is a principle of mutuality which was held in. Though legally they are two different persons, for any given transaction which is being done by the entity, it is only doing it for and on behalf of it and not on its own capacity. So therefore there is no service whatsoever between the entity to its members was the essential principle. I'm just giving it in a very diluted manner. So then, though there was a definition of a business to cover the provision by a club, association, or a society or any such body of of the facilities or benefits to its members, but they felt treating the activity inter se was not covered in the GST law anywhere. So in order to overcome that, this amendment was essential and necessary, due to which this amendment is brought in. Now, impact of it, some of them I already explained, but still I would like to go point by point. First, this is the scope of supply is widened, no doubt. It is through this retrospective amendment from 1st of July 2017. Now, when I said that it is a retrospectively amended, effective from 1st July 2017, the primary questions which comes are, first, does it mean that wherever any clubs or association which had taken a stand based on the earlier jurisprudence to say that there is no tax on the activity between the clubs and its members now would be called to pay taxes? If so, yes. Is it to be paid only for the future transaction or even for the past transactions? 3. Even if it is to be paid for the past transactions, whether it requires to be paid along with interest. 4th, not only interest, can there be any penal consequences for having not paid or not disclosed, not declared, so many other aspects. To the first question, yes, they may be called upon to pay for the past because they're always said to be in the statute book. Obviously, if there was a time limit which was there to demand taxes had lapsed the normal period of limitation, which is still not lapsed. If it had lapsed, then they could not have been a demand for the same. But obviously now it is not at lapsed even for the 17-18 financial year. So therefore, still they have a scope to demand taxes for the past. 2, whether they can ask to pay interest. I would like to refer at this point in time decision of Honorable Supreme Court in case of Star India Limited also in the erstwhile law, where there was a amendment came in for retrospective amendment, where the provision were said to be they asked to pay taxes for the past on so and so date. They give some time limit. And where the interest was demanded for the past, they said no interest is payable because the Finance Act, which is bringing retrospective effect, retrospective amendment, said that it should be paid on a particular date. So that liability to pay arises on that particular day onwards. So therefore, the interest, if any, should be asked to be paid only for the subsequent period default, not for the old period. Though it is not straightaway applicable in my view, but still the rationale and going by the principle of equity, we can always say that since the amendment is brought into statute book retrospectively from a particular date, appointed date, so the liability to pay tax also should arise only on that day onwards and not earlier to that, and thereby the interest, if any, is to be paid only from that day is a possible argument to be taken. Now, if you ask me, sir, is it worth taking that argument and fighting with the department? I would surely say yes, for the reason because there is no interest on interest. Even if you pay the interest today, it will be the same amount. Even if you pay interest after having paid the tax today, after 5 years you are liable to pay interest, the interest amount would remain the same. So in other words, there is no interest on interest. So it's worth contesting it. If it is held in favor, no problem, you need not pay. If it is held against, on that day you'll be paying the same amount, so there is no additional impact. And as to the question whether there will be any penalty on the same, answer would be no, because there was no intention to evade payment of tax, and you have paid the tax voluntarily, and there cannot be obviously penalty on these type of retrospective amendment. And unlike other cases where generally they bring in a retrospective amendment where it says that this amendment would not affect the right to collect interest, penalties, etc., or those wordings are not similarly there in the Finance Act. So therefore, in my view, interest can be surely contested, need not pay, and later on, even if it judicially, if it is held, then we can examine at a later point in time. This is what is my personal view. There may be differing views on it, but this is what is my personal view on that aspect of interest on that aspect, where if somebody is required to pay. And the next is whether should I can I use cum tax benefit, that is inclusive tax benefit, if it is not separately collected from members. Now obviously in my view you can do that, thereby the effect of the taxes can be reduced to that extent. As I said, the second bullet point is concerned, it is essentially to overcome the impact of the decision of Honorable Supreme Court. Then essentially to bring in the tax aspect of association and its members. Activities transactions, I discussed about it. Whether this amendment is intending to cover partnership firm, LLP, and as against its partners, in my view, no. Surely no. Though the matter can go up at different levels if it is so going. If the government comes out and clearly clarifies, it's fantastic. Otherwise, also, if it is so taken, it is clearly contestable, because the law can always be interpreted with the purpose for which the amendment was brought in. Applying the interpretation rule, mischief rule, we can always say so. Okay. Whether it covers an activity or transaction for non-monetary consideration, though there are differing view, there is a possibility with the grounds which I discussed to say that it cannot cover a transaction of a non-monetary transaction between the association and its members. And these are the points on the first bit of an amendment in the scope of supply in section 7(1). Consequent to that amendment, there was also one more consequential changes in second schedule retrospectively, where para 7 of schedule 2 or entry 7 of schedule 2, whatever you may call, where it was saying the following shall be treated as supply of goods, namely supply of goods by an unincorporated association or body of persons to members thereof for cash, deferred payment, or other valuable consideration. This is what was the wordings which were there. This was only covering goods, it was not covering services, point number one. This also was one of the concern before the council when they said that, the decision of Honorable Supreme Court can impact the collection of taxes from on the clubs for all the activities they carry out to its members. So this, since they have made their sweeping amendment in section 7(1) itself, there is no necessity of this part being there in schedule 2, and more so with the amendment made to section 7(1), section 7 itself, by omitting 7(1)(d) and adding 7(1)(a), 7(1) capital A, whereby they said schedule 2 is merely for the purpose of classification and not for the purpose of actually defining it to be a supply. So with that also, this entry was not serving any purpose. So that is why here that particular entry is omitted or deleted from the statute book. One more very impactful amendment, which in my view is going to create a lot of impact on the business, is this amendment. As we all know, section 16(2) lays down 4 conditions. Condition number 1, possession of the tax-paying document. Second, receipt of goods or services, as the case may be. 3, tax whichever is charged by the supplier is paid to the government either by cash, that is the cash ledger, or through credit ledger out of the eligible credits. 4, the recipient, that is a person who is claiming a credit, has filed their return, periodical return under section 39. Now they are adding one more condition to it, that is the details of invoice or debit notes referred to in clause A has been furnished by the supplier in the statement of outward supplies. So this is one part of it. Second, such details have been communicated to the recipient of such invoice or debit note in the manner specified in section 37. So uploading of invoices in through GSTR 1 by the supplier, invoice or debit note as the case may be, and that being communicated to the recipient through 2A or with modified 2B is an essential condition which is added. If I go to the fundamentals, what I am seeing is the very mandate of bringing in the GST law was a free flow of a credit. There is already interpretations which are coming out by different high courts as to the question whether the input tax credit is a benefit being given by the statute or it is a right of the assessee or the registered person. No doubt certain decisions have interpreted referring to certain provisions, certain decisions in the rest by law. There are certain changed circumstances which requires to be considered or reconsidered, which is going to be tested before the highest forum, this Honorable Supreme Court. One, the mandate or the purpose of the constitutional amendment. 2, the very purpose of increasing all the tax rates in the GST law is with the assumption and presumption that the supplier is going to get an input tax credit. On the one hand, the tax officers are entitled to collect higher rate of tax. At the same time, they are putting a lot of restrictions onto the taking of credit. Whether it is in line with the mandate of the Constitution is a question which requires addressal. And second, whether it is a right of a assessee to get his credit once he has complied his side of responsibilities, leaving apart what should have been done by the other side. One of the recent decisions do say when no action is taken against the supplier for the default, you cannot come back on to the recipient and try to deny the credit, because he has done his part of the duty. One more amendment in this particular Finance Act itself also gives a similar implied view, where it says that once somebody has uploaded their invoice, irrespective of the fact they have paid the same or not, the government is entitled to initiate a recovery proceedings directly. So which means that there is a clear-cut powers given for the officers to act and recover. So if they are recovering them, failure on their part and coming to the recipient side and denying the credit is not just and fair, in addition to the other legal principles. So I think, in my view, this amendment would be tested before the courts. And finally, the government may not also accept those decisions of different high courts, even if it is rendered in favor. At the same time, assessees also may not leave at the high court level if it is going against them. Those matters may go up to Supreme Court and tested over there. But meanwhile, the question comes as a professional professionals like us, when we are dealing with various small and medium scale businesses, can we take such arguments and try to contest? Do we have a strength and power to take the matters and fight? So how we have to deal with this is going to be a major challenge. One possible suggestion from my side would be, wherever such credits are there, maybe you should lodge the claim for the credit and keep it in abeyance for utilization with an intimation to the department till the issue gets settled, so that you do not lose out that amount which is going to be subsequently, if it is held in favor. At the same time, if it is held to be not favorable, then I think obviously you have you can reverse that amount which you have lodged without utilization. So it depends on business to business, risk appetite of the entity, the ability to take the matter to the higher forums. So all these factors needs to be considered for taking any viewpoint. There cannot be one straitjacket answer as to how to deal with this amendment practically for all the businesses. There cannot be one single answer for the same. Now, one more aspect which from the beginning of the GST law, I always have been debating on, is whether the conditions under section 16(2), is it a condition precedent for availing a input tax credit, or is it sufficient if I am able to fulfill those conditions even at a later point in time? Example, though I have not fulfilled certain conditions contained in 16(2) in the month in which I take a input tax credit, but subsequently I am able to fulfill those conditions. Again, it goes on with different arguments, because as far as 16(2)A is concerned, it is a merely the conditions. Also, I can make it into two aspects. One is a condition which is in the procedure, which is of a procedure and technical in nature. The condition which is of an essential in nature, I mean important in nature. As far as condition number 16(2)A is concerned, possession of a document. So sometimes it may so happen that I was not having a document on the day when I took a credit, but subsequently I have received that invoice document. Can the credit be denied later on to say there is an evidence available with the department that the invoice itself physically couriered to the recipient in the next month than the month in which the credit is taken? can that be a basis to deny the credit? 2, if I am not, whereas the condition number 16(2)(b) is concerned, receipt of goods or services, I think it's a condition which is of a substantial in nature, which in my understanding may have to be read as a precondition. Charged, tax charged and paid to government. When we are talking about a paid to government, here the date of availing an input tax credit, if somebody say filing its return, he would have claimed it on say the 2nd of the next month, but the other fellow would have not filed the return on 2nd. He may be filing a return on say 18th or 20th. So that being a case, can it be argued to say that tax was not paid on the date of taking a credit? In my view, again, this is a condition which is of a, we need to establish that even though subsequently it is paid on that. Obviously, filing return is a precondition because that is the only methodology presently prescribed in the GST law. To the manner in which I claim credit is only through filing of return. I think this is something which I always been propagating, that there should have been a different methodology than filing a return. There should have been a separate methodology to claim a larger credit into the government. I mean, in my account. So they should have enabled me to file my input tax credit ledger or sort of a similar amount independent of the monthly or periodical return to claim a credit. So, okay, leave that apart. But here, this is also a condition. Why I am discussing on this is now this AA, that is 16(2)(a), is it a precondition or a postcondition? Going by whatever it is said, it is being shown. Now, if we read 16(2)(a), read with rule 36(4), which presently the way it is, that we are entitled to take input tax credit of whatever the credit which is reported in the whatever 2B presently, plus additional 5%. Now, there can be two situations where the rule continues to be there in the statute book even after the appointed date, and obviously that gives support to an argument to say that 16(2)(a) is only a condition to be fulfilled even at a later point in time, because that 5%, though credit is not entitled, rule is enabling. So the intention and the thing is clear to say that it is subsequently can be fulfilled. If consequent to the amendment being made effective from the appointed date, if they remove 36(4), that condition or the rather condition or a provision to say 105%, then obviously it would say that it becomes a precondition. That's the interpretation at least the government would like to place upon. So I think in that way, if we look at it, also the trend which it is showing, where 120%, then 110%, now 105%. So maybe after appointed date is 100% only. So that means until unless reported, we are not entitled to take a credit. So I think it may ultimately lead to such situation. But wait and see. But let me tell you, this provision is going to hamper the cash flow substantially, especially with this pandemic or any other reason why the supplier cannot file their returns and upload. So, disclose and get communicated whether I am eligible to take credit and all those aspects, where if I will pay, without some cases where I don't pay, they don't release the goods. Though I have paid the tax amount to the supplier, they would have not uploaded, or even if they have uploaded, they have mistakenly uploaded to some other number, or they have uploaded into B2C instead of B2B. So all these things would cause unnecessary business difficulties, which becomes essential for all the assessees in the GST to ensure a strict compliance, to ensure the reporting from the supplier for different means. Some of these assessees have a methodology unless the credit is appearing in GSTR 1, will not make a payment of the taxes or the basic invoices. All those questions may come up. Now with one more technical issue which was being discussed in one of the groups is this invoice furnishing facility. Whether that provision is issued under section 37 or not. If it is not set to be under section 37, then how I would be entitled to take a credit in the month, first month and second month. So should we wait until the third month till they upload GSTR 1, including those credits? Though it appears in our whatever the 2B, whether it is in compliance with section 16 to A was a matter of debate. Okay. So I think these are, and what I was just trying to say also, the impact on cash flow is going to be high. They have to design themselves to address those cash flow issues as well. The next important and major amendment as far as chartered accountants and cost accountants are concerned, removal of GST statutory audit. They have stated in the council meeting 4 different reasons why they had to take such decision. One, they said there were reports of not a good experiences from the businesses from as to the GST audit. 2, there was lot of postponement in the extension of the due dates. 3, cost to the businesses were more, SMEs, etc. 4th, they said the collection aspect from 9C was not quite substantial as compared to GSTR 9. So therefore, no much purpose would be served with filing of 9C is concerned. I have my personal differing opinion on all these aspects, but nevertheless, there may be a differing views on that as well. Leaving that apart, on my interaction with various professionals from different places, it was a mixed reaction which I think I got out of this. The one side of the view was it was good that it is removed for many reasons. The reasons may be that many of the aspects, though we explain to our clients, especially these are coming from official places where they say the clients are being there with for past so many years, we can't take a tough stance against them as to forcing them to pay because there are differing views in some cases. But at the same time, we have to affix our signature and the responsibility is on us to take that burden. So it is good that now it is a responsibility will guide. It is a call of the assessee to go with our suggestion or not go with that suggestion. So therefore, we are relieved from our responsibility to certain extent of taking certain tough stance against the assessees, which we are not sure about the law because the same aspect may be treated differently from different auditors. So I think that was a concern which they said it's good that it is there. And the second thing, again, though we were doing this additional work, clients were not paying anything additionally, and the amount and effort, the amount of effort which we have to put in for carrying out this audit was quite substantial and was not appropriately compensated by the the assessees or our clients. So I think that was another concern which they had always. And on the other side, the other side of the chartered accountants, they were saying, no, actually, we are, though not certifying, we will be taking a responsibility on behalf of our client. So whether the audit is there or not there, we have to do the same amount of work and exercise the same amount of caution, but still will not be remunerated that separately for that. It all depends upon case-to-case basis, but majority of the cases, especially the more facile places, they may not get additionally compensated, especially in this present scenario of pandemic. It is difficult to get the regular fee itself, then how to expect an additional fee is a one more concern which are being there. But technically speaking, it was always the scope of this audit itself was not clear. Are we merely supposed to comment upon the difference as to the turnovers and credits, etc., or are we supposed to carry out the correctness of all the transactions being carried out by the SSC, including its compliances, record keeping? That itself, there was a divide as to the standpoint. Though our institute was clear that we need to be doing extra caution and do not merely a balance between the figures or reconciling figures, it's much beyond that. That is what the intention of the law. But having removed that, that question is no more there in front of us. Now, whether this amendment is going to, one more aspect I would like to highlight, when the audit was there, where a chartered accountant was certifying the reconciliation statement, for whatever reasons, if later on during the course of verification inquiry, if the departmental officers finds it that some aspects have not been appropriately handled in the GST returns, either annual return or regular return, and consequently it is not forthcoming in the 9C or the reporting points over there, one, they could have made the auditor as a witness against the SSC, being having carried out the audit of the records. Two, if there is any default, they could have questioned the auditor also and made him also a party to whatever extent in that respective cases for the default from the SSC side. So I think these were also challenges which would have come up, I think, which would not be there in the present scenario. As it is, we have seen even in the residual service tax regime where certain aspects like, reported in the financial audit reports as to certain aspects of service tax, they had summoned the chartered accountants, asked questions about the disclosure aspect and not disclosing the liability, though there was a liability in the books and taxes collected, not paid, not reflecting that appropriately in the financial statements. Certain questions were asked and made them a party to the proceedings. So I think that would have been much more, would have been used as one of the additional tool to confirm, especially if the auditor had commented upon a particular transaction in their 9C report, that would give an additional point or a ground or a weapon in the hands of the department to confirm their proceedings against any SSC. So I think that way all this development legally and technically, in my view, is good move in the interest of the professional as well. No doubt it may cause impact on their revenues with an additional work though being there. So can't help it. It's a part of various compliances being added day in, day out for a chartered accountants with not adding that much revenue to fulfill their efforts. Next question is, as I said, this will become effective from the date to be notified. The question which comes in is whether the old provision of audit is applicable for 1920. They clearly clarified the 9C is applicable. The question which is coming up now is for 2021, whether the amended law, that is the deletion of section 35, is applicable. Since it is not made effective as on date, it appears that people is required to do, but the clarification and the talk is that no, for 2021 there is no requirement of an audit and will be made effective shortly. So once it is made effective, being the procedural law, whatever the procedural law which is there on the date of compliance has to be applied. So thereby there may not be requirement of filing GSTR 9C for the financial year 2021. I think so. These are certain aspects related to GST audit being removed. And as far as the reconciliation statement, consequent to removal of audit, section 35(5), there is a amendment in the way the provision is worded in section 44, where it is saying every registered person other than ISD, person paying tax under 51, 52, casual taxable person, and non-resident taxable person, excluding those specified people, required to furnish an annual return, which may include a self-certified reconciliation statement. Reconcile the value of suppliers declared in the return furnished for a financial year with the audited annual financial statements. Earlier, the Act itself was defining what is the due date, that is 31st December. But whereas the amended provision is giving that power to be notified in the rules itself to say within such time in such manner as may be prescribed. So there is an amendment expected in the rules as the forms and formats in which the annual return and a reconciliation statement, which will be attached or forming part of the annual return, would be published. So with that, we'll have to look at how it appears. Once it comes up, we have to see the nitty-gritties, what is to be filed, how it will be connected, whether there will be in the same manner as it is presently their annual return, or will there be a change in the annual return, how it is to be done, whether we need to change our softwares, whether we need to change our reporting system to match the new format. We have to work out and see. My humble suggestion for my professional friends is that whenever we are finalizing, in fact, up to last year it is a different scenario, since that we'll be finalizing 2021 presently, it is suggested that we do all this reconciliation exercise simultaneously for the GST with the GST returns also before we finalize the financial statement. Essentially, it is suggested to do that exercise before September so that any omission for credits, any adjustments, credit notes, debit notes, whatever those adjustments can be done before September, and also suggest for a filing of the returns up to the period March before September, so that all the credit is lodged and all the entitlements are done correctly and compliances are taken care appropriately. So that before finalization, make it as a part of your annual audit itself as to the reconciliation part. Otherwise, it may create double work, and also there may be any errors in the financial reporting which may arise at a later point in time. Examples would be the credits availed by entities without being reported in 2A and 2B, and on verification on a sample basis, many of the suppliers may not be genuine. The KYC of the supplier could not have been taken, which are the basis on which they are trying to deny the credits. So, in fact, one of the aspects which I thought I will say in section 16(2) itself, implement a system of KYC for your suppliers, means your client suppliers, ask them to implement for your client suppliers, so that later on when any question comes as to genuinity of the supplier, the responsibilities which should have been done from the person taking credits are complied from his side. So I think that can be one important aspect which you can suggest your clients. There's a provision which is also coming in section 44, which is talking about the who can be exempted from filing an annual return. Probably this 2 crore limit and all those things may be notified under this provision to section 44. And coming into the second provision, it is giving relaxation from filing annual return for government, either central government or state government or local authority. Please note, it is only covering government and local authorities, not covering other governmental agencies. Where also it is saying that government departments of central government, state government, whose books of accounts are subjected to audit by CNAG, so or any other law for the timing info by auditors, the accounts of them. So I think with that, these they'll be out of annual returns. All other things would remain the same. As I told in my little while ago, no doubt we may be not having a responsibility of signing the reconciliation statement. Obviously, as an auditor, though this is a responsibility of assessee to do it, as a part of an audit, financial audit, this may be one of the aspects, being a statutory auditor also, to ask for, to get before we finalize our financial audits. The next changes which I wanted to discuss was the interest, provisions relating to interest. We all know the provisions relating to interest have been interesting from the day one. I will take an example and try to explain what was the problem. Say, for example, an assessee whose turnover was, say, 50 lakh, rather 1 crore, and his liability was 18 lakh for a particular month. He's already having a credit more than, say, 20 lakh in his credit ledger, respective credit ledger, to pay that. However, due to one or the other reasons, he couldn't file his return within due date. It may be that he met with an accident, or his accountant met with an accident, or he was negligent, or the accountant said, I'm going to file, or he said, I need to finalize some data, I have not done it, whatever may be the reason. So anyways, we have a credit, sir, no need to worry. So they filed their return belated. Now the question was, since it was the only way in which the taxes to be paid or input tax credit to be claimed is only returns, the effective date of payment of tax is counted or considered or reckoned only as on the date of filing the returns. Now the challenge was, what happens to the tax payable from the due date of filing return till the date of filing the return? Whether there is a delay in payment of tax. If answer to that is yes, whether the interest is payable from that period to that period and on what value. Though it seems totally illogical to collect tax, the way it was understood, I do not say the way law says, because even now I am of the view that the payment should have been a separate aspect which should have been made, not enabled in the law, in the system. So it is the return filing cannot be the date of payment. It is only a furnishing of information. There should have been a separate mechanism which should have been introduced and implemented for making a payment. This is also forthcoming if we read section 7512, also envisage similar circumstances. So going by that, anyhow, how it is understood as in the present way is the date of filing return is a date of payment of tax. So thereby, for the entire 18 lakh, from the due date of filing return till the date of filing return, the assessee was required to pay interest. In fact, it went, Hyderabad High Court did said, yes, until you make a payment, the amount will be there in the cloud. It doesn't go to the government exchequer. Therefore, there is no payment. The payment is only the actual filing of return. So thereby, since the return is not filed, the interest is liable to be paid. However, differing views were coming. The council was apprised of. They said, no, we agree. The interest cannot be asked to be paid in cases where there is a delay in filing return, but there was sufficient credit. However, the provision was added in Finance Act 2020 itself, but again, there was a lot of interpretation issue which was coming in over there. Though it was made effective, again, there was a thing whether it's retrospective, not retrospective, all those things. So now, leaving that apart, they have added a new provision over here to be effective from 1st of July 2017 to say that interest is payable in cases, I repeat, in cases where the returns are furnished after the due date. For the supplies not made alone, made and declared in that period. So made in a period and declared in the return for that period, but the furnishing of the return is happening at a later point in time. This is covering only that situation. Why I'm emphasizing this, I'll talk about it a little while later. First, it is saying in such a scenario, interest is payable only on that portion of the tax which is paid by debiting the electronic cash ledger. However, it comes with an exception. If you are filing this return after the initiation of a proceeding or rather commencement of the proceedings under section 73 or section 74. Now, please note here, when is the commencement of proceedings under section 73 or 74? Enquiry proceedings, either under audit or in any other investigation, etc., are different proceedings under different sections. But to demand tax, a notice, issue of notice to demand tax, determine the tax, which is short paid, not paid, etc., are covered under section 73. So the commencement of proceedings, in my understanding, is only after issue of show cause notice, either under section 73 or 74. However, later on, rule 142(1)(a) was added, wherein by virtue of section 73(5) or 74(5), the authority, the proper officer, is required to communicate, intimate the quantified tax and give an opportunity to pay the tax along with interest to conclude the proceedings without issue of show cause notice. Now the question arises whether even a notice issued under section 73(1)(a), sorry, 73(5) in DRC 01(a) is also a proceeding under section 73 or 74, because it doesn't say 73(1) or 74(1). So in my view, yes, before issue of such DRC01A, if you have filed your return, you are entitled to take the benefit of this proviso and pay interest only to the extent of amount paid in cash ledger. If 1A is issued, then after which you are filing the returns, then it may be a challenge. Though we can argue still that 73(1) proceedings is commenced only after issue of a notice under 73(1). Otherwise, it's only an option given for us to pay, and it's not a proceedings initiated under 73 or 74. Can be a possible argument, but it may go either way, depend upon how the judicial forums are going to take a stand on that. Now, I explained about the interest in a scenario where there is a delayed filing of return, but things doesn't work on this type alone. Say, for example, in the same example which I took, 1 crore turnover, say for the period of January 2020 or rather April 2020, where I have filed the return somewhere in August. I had a sufficient credit, fine. But due to clerical mistake, instead of declaring 1 crore of turnover, I declared 90 lakh turnover and filed the returns. Then I realized a mistake in the next month and added the turnover in the next period, that is for the month of May 20. Filed in the same month of August. After this one, then within maybe 1 week, if I realized it, I did a correction in therein. Now the question is whether can I take a benefit of this proviso. In strict reading of this proviso, it may not be directly applicable over there. However, going by the intention and intent, there is a possibility for us to take a similar stand to say, since there was no liability to be paid in cash or cash ledger, I am not required to pay interest on that additional 1.8 lakh on the 10 lakh turnover which I declared in the subsequent month. Second scenario in the same thing, I do not have a entirely sufficient credit. I have only a credit to the tune of part of it. Instead of 1.8 lakh rupees, I have a credit balance of 1,80,000 I'm utilizing, I'm paying through cash. Then am I liable to pay interest on that 80 lakh? If so, from which date and on what value? The safest or erring towards the revenue is on that 1.8 lakh, okay, 80,000 rupees from the due date till the date of filing the return. Now, the one more extended question connected to this, which is unaddressed as on date, is why we are looking into only debiting in the cash ledger. Why not the balance lying in the cash ledger? So again, it is going to be a matter of debate which requires to be discussed in a days to come, because there's also, I would have paid a tax to the government but not filed a return. For delayed filing of return, the unnecessary interest being asked to be paid, though the amount is already lying in the government account. In fact, it also worth reading section 50 carefully. It is talking about from the due date of filing return till the payment of tax to the government. It is not paying tax to the government. Is it by depositing the amount into cash ledger or Is it by appropriating the amount in the cash ledger through returns? Is again one more point which requires debate and discussion. Connected one more debate which is there, if we read section 73(1) or 74(1 for that matter, it talks about short payment, non-payment, irregular availment of ITC, irregular utilization of ITC, erroneous refund. When we are talking about irregular availment of credit, for all these things, commonly the words used is, it shall be demanded, asked to pay, to pay the tax along with interest payable under section 50 of the GST Act. Now, please note, interest payable under section 50. What does it mean? 51 talks about where there's a short payment of interest in cases where it is remitted late to government exchequer. Subsection 3 talks about where the entire system of GSTR 1, 2, 1A, 2B, 2A, all were operating as was originally envisaged, in spite of their excess availment under certain provision is only envisaged in section 50 subsection 3. Since the entire system is not envisaged, in my humble view, section 50 subsection 3 cannot be invoked in any circumstances in the present state of affairs. Now, it is irregular availment is concerned, there is no straight interest envisaged in section 50. And when it comes to even 51, section 52 says the interest payable in terms of section 51 shall be quantified in the manner as may be prescribed, but the rules have not come out and prescribed anything as on date. In fact, on that matter, there is already a writ petition filed in Karnataka High Court, but still the matter is not taken up and heard. The point is, there's a lot of issues in this interest itself. So whether the interest is payable, not payable, what is the quantum, to how to pay. So always, whenever there's an interest liability, if you can afford to take a panga, there's a litigation, you can always say that, since there's no quantification methodology prescribed in section 50 subsection 2, I need not pay interest, can be a very, very extreme argument. But still, as I said, there's no interest on interest that can save you some time to pay the interest amount to the government. So that is something which I thought I'll just share. So this 73, which I was just trying to say, again, when there is no interest in a stricter sense payable under section 50, then even though section 73 referring to payment of interest as payable under section 50, when that itself is not payable, the question of interest being recovered on the irregular availment which is not utilized is possible to be taken. In fact, Patna High Court has already come out with a decision to interpret section 50 subsection 1 as far as the credits, especially the transitional credit is concerned, where it said, when you avail the input tax credit, there is nothing which attracts, which makes the interest payable. However, if you have utilized that credit which is availed, to the extent of the credit you have utilized, you have not effected a rightful tax payment. Thereby, to that extent, there is a short payment, in which case there will be an interest payable under section 51, which is getting attracted. That is how we have to read. Once availed but not utilized, there cannot be any interest payment, is what is a principle which is explained in that decision. I think in my view, that view is proper view and rightly so analyzed. The next changes essentially are connected to amendment in section 129 and 130. There is a provision in section 74 where there was a provision which said that when the proceedings against the co-notices, whose co-notices? Say, for example, a person has making a sale without payment of taxes, and there's a other person connected to that same transaction who is enabling or involved in the chain of transactions, and a notice is issued to the person who is selling that goods without paying appropriate taxes, and the person who is enabling or involved in that entire loop of transaction were also issued notices or to be issued. So this provision says, in fact, still this is valid for penalty section 122 and 125, which I think there is some scope for using this provisions in the context of the present cases where there are multiple people involved in a same set of transaction involving the movement of documents without movement of goods, especially in the circular trading, that proceedings initiated in the same set of investigation for all the other people involved. Once the main person is proceedings in the main person is concluded through whatever the means, either by payment or otherwise, the proceedings under against all others also has to be concluded, the penalty proceedings under section 122 and 125. So I think that there is also a reference to section 129 and 130. Now that they have made 129 and 130 as little different, operate in a different manner, making section 129 a completely an independent provision. I think this reference to section 74, I mean in 74 as to 129 and 130 is omitted. There's an amendment to section 7512. What exactly section 7512 says is that if any registered person who has self-assessed tax and filed the returns but have not paid the tax or interest payable thereon, then the recovery provisions under section 79 can be invoked. I mean, basically, without issue of notice, they can initiate directly a recovery proceedings. Now, this is what I was highlighting. Section 7512 envisages a situation where returns are being filed, disclosing the liability, self-assessing a tax, but not paying a taxes. But the portals or the GSTN or the way it is designed is not providing for it. So there's a complete contradiction in sections as regard to section 7512 vis-a-vis the way the law is operating. So this, based on this, also one high court said even though the tax is not paid, they should permit them to file the returns. So anyway, leaving it there, the amendment, what it is saying there, when we're referring to self-assessed tax in section 7512 is concerned, it is saying it is not only including the returns, because 37, that is a GSTR1 is not a return, it's only a statement. They want to include even the details furnished under section, under section 37 through GSTR1 is also a self-assessed tax, and enabling the authorities to go ahead for recovery of the amounts declared but not paid. This basically to enable them the recovery provision wherever a few people who only file GSTR1 do not file GSTR3B. So they can go behind them and attach the property, attach the bank account, and initiate all the powers given under Section 79. And obviously this is going to create a lot of disturbance in the trade, especially in this present scenario where people, on the one hand, I file GSTR1 because it has to appear in the 2B of my recipient, and at the same time, if it doesn't appear, he will not give me a payment. So once he gives a payment, then I can file 3B. So now, for any reason I am not able to pay the amount and not file 3B, they will initiate recovery, which is going to actually paralyze the entire business by initiating this recovery. In my view, it is very, very stringent move. Fortunately, still it's not notified. I hope that till all these problems of the businesses and the pandemic is settled, this is not activated. Okay. This is about amendment to. One more important thing I wanted to highlight here is there may be a situation where there may be genuine errors while filing in GSTR1, due to which there may be an excess amount in GSTR1, which might not have been. I mean, you would have assessed the tax in 3B, but not. Obviously, you would have corrected those mistakes in 3B. Whether the department can straight away initiate a recovery proceedings by giving attachment notice to the bank and all those things. There is a decision of Karnataka High Court in this regard when the similar provisions of Section 75 12 was invoked for recovery of interest. The Karnataka High Court said, which is also upheld by division bench later, said that if the interest amount is being objected or questioned, the quantification, etc., the department is bound to issue a show cause notice, and they cannot simply proceed with the recovery proceedings. So in that direction, my suggestion would be, wherever such errors are there, it is ideal that to the extent of the difference which is there between GSTR 1 and 3B, for whatever reasons, if it is there, you may do a reconciliation and the reasons for that difference and intimate to the department in advance before they get into this mode, so that you can always say you explain the reason and it's a genuinely there's a difference. Sometimes there may be an excess payment of tax in the previous month, which would have adjusted in 3B turnover in the present month due to which there may be difference. So there are various reasons practically when we see. So we may have to look at those differences and see how and better to intimate to the department to avoid this type of unnecessary hassles in the business. Again, there's a provisional attachment provisions which were there in Section 83. It was confined to only certain sections mentioned therein, but now that powers to initiate the provisional attachment provisions is extended to various other proceedings as well. I think again this is giving more powers to the officers, affecting the businesses. At the same time, in the decisions have of late come out to say the high-handedness of the officers and have cautioned the provisions of provisional attachment is special powers given to be used in extreme circumstances and should not be used sparingly in all circumstances and very cautiously to be used. I think we have to see how the government reacts to those decisions, and consequently, if they issue such directions to the officers concerned, it will be very useful. I think, yeah, I can move on to the next one. I will deal with this provision, and then though this is connected to amendment to section 129, nevertheless, I would cover the appeal aspect of it. As we may be knowing, for anybody to file appeal, we need to deposit 10% of the tax for the first appellate authority to file appeal against any order passed. They have made a special provision as far as the order passed under section 129(3), where it is saying unless 25% of the penalty is paid by the appellant, the appeal shall not be entertained. Now, if we see 25% of the penalty with the amended provision is working out to 50% of the tax, because penalty is equal to 200% of the tax payable. So in other words, 25% of the penalty is equal to 50% of the tax amount. So whereas as against the 10%, we are going to pay 50% of the tax, which is quite substantial. This is, however, this is only applicable for orders under section 129(3), which is related to e-way bill related violations. The changes which are made under section 129 is worth noting. 129 is a provision which is dealing with violation of provisions of the Act and rules when goods are in movement or in transit or being stored during transit. Most of the officers, especially the state, have understood this provision against the very purpose and intention of the statute, in my view. The provisions of section 129, with the way it is worded, should have been, or to be read down to say, because if you compare this with section 73 or 74, even in 74 where there is a fraud, collusion, fraud, misstatement, intention, evade, short payment or suppression to evade tax, it is talking about penalty equal to 100% of the tax. Just putting both of them together, the law could not have envisaged any of the violations of the rules to be seen so seriously as beyond that of section 74. So going by that, here if we see, when it is talking about in contravention of the Act and rules, and also which is talking about a scenario where the owner does not come forward to make a payment, which is, it shows an intention behind it, that somebody is moving a goods or storing a goods during the transit with a clear intention of non-payment of tax. Though everybody is reading it to be a e-way bill related provision, actually it is not so. In my view, personal view, there may be differing view, but my personal view is 129 should be read very strictly, because the way it is worded, the quantum of penalty which it is proposing, it is to be only applied in cases where there is a intention to evade taxes and it is being removed for the purpose of movement without payment of taxes or without intended payment of taxes can only get covered. But leaving this very substantial intention behind it, the amendment which it's proposed is exactly seems to be going against, where they have clearly made the overall provision an independent without linking it to any other provision. Why? Example is, say for example, a goods is moving from, say, Maharashtra to Tamil Nadu. The goods are intercepted in Karnataka. Karnataka do not have any authority to either collect tax or enjoy the benefit of the tax, because the tax to be paid, no doubt, in Maharashtra, being the person who is supplying the goods is registered over there, and ultimately the benefit of the tax should go to Tamil Nadu, being the recipient located over there. There is no money or the taxes which the government of Karnataka is entitled to get over. Now, if any, it is talking about a tax payable on that goods. What is the tax payable on the goods? The tax payable is IGST, never was a CGST, SGST. Even if it was a CGST, SGST, it was that of either Maharashtra, or for that matter, obviously not the, the Tamil Nadu. Whereas when any vehicle were intercepted and they wanted to collect the invoke section 129, the taxes in many cases were collected as CGST and SGST of Karnataka, and consequently penalty also on that particular head. So therefore, there's a lot of anomaly which was coming in. So they have said now with this amended provision, there's no tax payable, only a penalty. And the penalty, again, who has a right to collect this penalty? All those are another legal questions which is going to come. Nevertheless, this 100, whatever tax 100% plus 100% penalty, the quantum is not going to change, but only the character of the payment is going to change, and that will be termed as only a penalty, not a taxes. Again, the other changes in the case of exempted goods, there's nothing much which is changed over there. And again, when it comes to when the owner doesn't come forward, there's again 2% of the tax, and if the tax is not a set, then the 50% of the value, whichever is higher. So both of them are to be. Now the other changes which they have brought out is, presently as the law stands today, the confiscation proceedings would get invoked after expiry of 14 days from the date of detention or seizure. In the revised thing, after the copy of the order which is issued, from there 15 days. However, the vehicle is permitted to be, released on payment of either tax or 1 lakh, whichever is less. So I think the not tax, the demand amount, which may include the tax plus the nothing but the penalty. So I think this is what is the revised provisions of section 129, and the references of section 129, which was there in other provisions, have all been removed, whereby they have made this as a self-contained provision in the respective CGST acts. So therefore, in the example which I was telling, the Karnataka state officers will be entitled to collect that amount as a penalty in that state, and will be eligible to enjoy that particular amount for that state, is what I think is expected out of it. Again, if carefully seen, there may be a possibly many points for challenging this provision as well. Again, when there's a reference of section 67 as to the procedure for release of the goods on a provisional basis, since there is already a provision contained within section 129 1C itself for the release, I don't think that there is a reference required under section 7. So also the intention was to make this provision independent of all the provisions. I think they have may remove that reference to section 67. Section 130 is now, there was a opening sentence in subsection 1, which was talking about notwithstanding anything contained in the Act, if there's a violation, blah blah. Now they have not made that as an with non-obstante clause. Now, if, which in other words means, if already proceedings under section 129 is initiated, I need not come back to 130. Only if there's no further action from there, then only I can come here. Or similarly, they have made 129 independent from that of 130, and they are giving reference to 130 at a later point in time. So I think this is what is the way it is designed as far as 130. And section 151 is amended to 121 as well as 122, basically to call for the information and use the information collected from different authorities or different persons. Earlier it was only by calling information from certain people, but now it can be from any source. They can collect anybody, they can ask for information which needs to be furnished. Based on that, they can initiate a proceedings. But however, there is a one check which is given. Any information collected by them to be used against any person, they need to give him a notice and give him an opportunity to say whether why that information should not be used against that particular person. So it is not that they can issue directly a notice against that. If any information is called for from a third party and based on which the information they want to initiate a proceedings, they can do such only after first giving an opportunity and explaining him and asking him why and such information should not be used against it. Then only they can proceed against that particular person. I think these were the changes in the Central Goods and Services Tax Act, and correspondingly there will be amendment in the respective state GST law. After that, there will be appointment of a date from which those will be effective. Though IGST Act doesn't require a concurrence of the states from this respective legislature perspective, no doubt even this provision also, amendment to IGST Act also has been set to be made effective from the date to be appointed. So I think this also will come into effect from the date from when it will be notified date. Now, what is this section 16.1? 16.1 defines zero rated supply. There, before this amendment, supply to SEZ was not attached with any condition. It was treated as zero rated supply by mere supply being effected to SEZ developer or SEZ unit. Either it was for authorized operation or not for authorized operation. It was not really mattering. But the rules for refund was envisaging that only if the supply to SEZ is for authorized operation, the refunds were entitled for. The question which came in was whether the rule was going beyond the scope of section 16.1. Obviously, it was yes. So probably in order to give effect to that, they have made these changes. Now there are two aspects to this. Earlier, it was only a condition to be fulfilled for claiming refund, but for supplying without payment of tax under letter of undertaking or a bond, there was no such requirement. But with this amendment, even for supplies without payment of tax, irrespective of the fact whether you claim refund or not, you need to fulfill this condition of being supplied to authorized operation. So it becomes essential for the people who are supplying to SZ unit to see the list of services which are de facto permitted or with a special permission sanctioned by the development officer of the SEZ, whether the services being supplied are covered therein, and ensure that is for the authorized operation. There's one more amendment in section 16 where export of goods, where the condition of realization of money in foreign exchange within a stipulated time for the purpose of claiming refund. This was brought in Rule 96B, whereas it is being now added into the Act as well. This is only in cases where you want to claim refund, but if you do not want to claim refund, still, in my view, there is no requirement of fulfilling this condition. One more change, which is being done with the purpose of avoiding or curtailing the certain mischievous exporters who were using the dummy credits, the invoices which they whatever you called the bogus invoice or whatever, through which the credit was coming and sitting into their credit ledger. Those credits were used for export of goods on payment of IGST, which is an automatic route to get a refund without much of hassles and difficulty, and it was coming and sitting. So they were getting a direct cash flow, and many, not many, I mean, some of the fraudulent exporters use this methodology to encash crores of rupees as refund. In order to curtail that, this is an amendment which is brought into the law where they are going to say that the refund of IGST paid on zero-rated supply of goods or services exported will be available only to class of persons or class of goods and services, which was blanketly available for all goods and services, is now curtailed only for class of persons and class of goods, which would be notified in due course after this enactment. So, I mean, not enactment, after the notified date. I think these were the changes, and in my understanding, this is going to impact many of the exporters, because this is one of the way they were getting their refunds easily, genuine exporters. But with this, for the default of a few of the mischievous people, the genuine exporters are going to suffer, because they have to undergo the rigorous verification of documents, etc., and dealing with the department. On the one hand, there is a promise which is coming out to say the interaction with the department will be curtailed. On the other hand, this type of verification is going to increase the subjectivity on the aspect of it. I think, so what's the time, sir? How much more time I do have, sir?
It's time now, sir. There are queries. We can.
I'll address the queries first and then move on to the next amendment, next aspect of my presentation. Because I did not have the watch with me, so.
It is only. It's already 7:55, sir.
Oh.
It is the time.
I thought it is still 1 hour or so. I was not aware that I already close to that much. So probably I would have taken much time.
How many more slides?
Sir, you can run through the slides, so you can answer the queries in mail, or else you want to take the questions now, sir.
I think I've completed one aspect of it. Though the changes are concerned, I'll just run through quickly, and then I will take the questions. That would be better. Your suggestion is better. I'll run through the other slides.
You can run through the slides quickly. For question and answer, we can also answer it in over mail. We'll share it to you, sir. You can respond it in one word or something.
I think better. Good. Thanks for that. Okay. Now, this notification, which is 6 of 21, where the dynamic QR code for B2C related transactions is which was there, requirement for a certain registered persons, they're extending. It was there up to 31st March, so to be implemented from 1st of April. They have postponed that further up to 30th June to be effective from 1st July, but with the condition that they have to comply. Here it is not, the provision is not postponed. The provision is already active. They said even if you do not comply with it, no penalty proceedings will be initiated, provided you start complying with effective from 1st July. So I think this is the changes which is there. Now, one more major changes is if any registered person has not filed GSTR 3B, that is their monthly return for 2 consecutive months, then it will not permit them to file GSTR 1 for the next month. So effectively curtailing them to enable the other fellow to take credit, though it is good from the perspective of the check on the fraudulent or the mischievous business, assessees, but at the same time, it is going to be too much harsh for a genuine businessman who is suffering for the financial crisis, because if he may not have money to pay 3B, and if he short declare in 3B, there's a recovery under 79. So there's a lot of issues which is going to come in. So on the one hand, if it doesn't upload GSTR 1, the supplier is going to, the customer is not going to make a payment. So this provision is, in my view, is very, very stringent and may put a last nail onto the coffin of the businessman. Then there was only a blocking of e-way bill, which is now this additional thing is being made. Similarly, for the quarterly return filer, unless they have filed a previous month's quarterly return, the GSTR 1 for the next period will not be permitted. The time limit for registration is increased from 3 days to 7 days. Further, if it requires other authentication and also various verification proceedings, then it is increased to 30 days. Then power to cancel the registration is, they are given powers even in case of excess availment of ITC. So that is again giving a enormous power to the officers. But again, this may be a question if we are able to question it in the court of law. This I also, there is a section 7512, there is a provision for recovery. At the same time, they have also empowered them to cancel the registration for a GSTR 3B being lesser than GSTR 1 turnover. So I think practically, as I explained, there may be issues. So that is why I suggested wherever there is a genuine reason for such differences, intimate in advance to avoid any of these actions. There's an amendment in Rule 21A where they have given opportunity to cancel the registration without giving opportunity again, though the rule doesn't say, in line with the principles of natural justice, surely that opportunity should be given. In cases where the GSTN was suspended, they have said that they cannot file a refund application once GSTN is under suspension. So again, this is creating a check on any of the assessees whose registration is suspended to claim refund or applying for refund. This may create again some cases where the time limit to file refund is getting lapsed. With this suspension, may put them into a worse situation, and they may be totally disentitled, causing severe hardship onto the business. This 1% tax liability in cases where any of the assessees whose previous month, that month's turnover exceeds 50 lakh, is required to pay at least 1% of his liability in cash, with certain exceptions being there. Majority of the assessees whose turnover exceeds 50 lakh may be covering the exceptions. I don't see much of a difficulty unless in some cases there may be a thing which may be represented, and offers are given for commission to relax. One more, in the Finance Act 2020, there was certain changes which were not given effect, which are given effective later. One among them is, and also very important, is the time limit to avail input tax credit under 16(4) was a September due date of filing returns for the month of September. However, for the debit notes, before the amendment, it was linked to the invoice of the supply for which the debit note was being raised that financial year. But with the amendment, the date counted for taking a credit was made from the date of issue of a debit note, not the date of original supply. However, that was not made effective. It is made effective from 1st of January to 2021. So therefore, in cases where there was a supply made in 17-18, there was a short payment of tax, if any, and now later on it is less today. You can issue a debit note today, and the other fellow will be entitled to take a credit based on the uploading of debit note which is raised in this current month. I think the another one was a penalty provisions for not only the person who is making a supply, whoever is getting benefit is also roped in into the penalty provisions. Registration thing, again, certain procedural things have been made. Certain refund related clarifications are issued as to that 1.5 times of the value of a similar goods exported. As far as the goods exported concerned, they have said though your value, say 100 rupees is the domestic sale price of a same goods or similar goods, but the export price is 200 rupees, though you would have exported and realized money for the same of 200 rupees, but for the purpose of computation of refund turnover, it will be counted for the purpose of refund turnover only 150, whereas total turnover is 200. So proportionally, the refund will come down. This was only a mechanism implemented to reduce the refund to be sanctioned by the government. Mistake, this is they enabled that you can correct all the IGST thing due to disclosure errors in the returns. They clarified that you can go ahead and claim, and that will be thing. I think this is similar to that. These are all procedures and extended due date up to 31st March. We are aware of it. E-invoicing 50 crores is already effective from 1st April. It creates a lot of challenges practically on various businesses. Because practically sometimes the pricings may not have been finalized. You may issue a revised invoice. All those things we are allowed to be curtailed and go with the strict compliance of thing. One more major changes from 1st of April is requirement of disclosure of HSN on the invoice up to 4-digit for the 5 crores turnover, beyond 5 crores 6-digit, and compulsory for all the associates. On the HSN side of it, let me caution, many of the cases they would have not bothered to look at it. It essentially requires you to look at it because many times the declaration of HSN going wrong, due to which wrong rate being applied, and consequently there may be an additional liability. Unlike a central excise regime where the misclassification would have impacted only the manufacturer, leading to differential collection of tax at only one point, whereas in the GST, it is going to have a multiple effect. For an example, if a particular manufacturer manufacturing a goods classifies goods mistakenly at a rate where it is 12% instead of 18%, the 6% differential not only he pays after say 5 years or 3 years, so after 3 years or 4 years, if the department comes and initiate the proceedings, not only he pays, all the people down the line is also required to pay. Say there are 5 different people in the chain from the manufacturer to the ultimate customer, 6 into say 4 people are involved. 24% will be additionally coughed up by the people in the distribution chain to the government. It is totally unjust, but nevertheless nothing can be made. I mean, we can't do anything else. So it has become, even in case of genuine cases, this will lead to it because other person will not be entitled to take a credit. At the same time, there will be a delay in time, unless as now the debit note is provision has come in. So where you can initiate the debit note provision and pass on the benefit. But however, if it is issued later after initiation of proceedings under section 74, if any, even the credit cannot be availed by the other persons or down the line. So this is very dangerous. Relook all the classifications which are made, rightly done or not, and applicable rate of taxes should be seen. If it is claimed as exemption, if it is taxable 18%, 18% into 4, it's quite substantially that can ruin the complete businesses in the entire chain link. 13.4, I already discussed. Common errors in UA bill, wrong PIN code, interchange, all those things. These are certain points which anyhow in the presentation you can look at it as a caution of word. I think with this I conclude. I'm ready to take a question, sir.
Sure, sir. I'll just share it from my end, sir. Okay, you can stop the slideshow. I'll just share.
Okay, I will stop.
Yeah, it's stopped, sir. I hope my screen is visible. I'm just sharing the screen. Is my Excel visible, sir?
Yeah, it's visible.
So we have something around 14, 15 questions. You can take it as much. We can go till 8:15 or 8:20 maximum.
Okay. Is the proper officer has the power to reject the application for cancellation on GSTN when there is no pending returns to be filed by the registered person? The RP is filing nil return for the past 6 months. If the answer to your question is, do has a power to reject application when no pending returns, unless he has other grounds to reject as per the provisions, he cannot reject it. You can always challenge such cancellation of registration. One more thing I would like to bring to your kind notice. Honorable Supreme Court has extended the time limits for all the proceedings under the any law. So the challenging in appeal is also extended, even any registration cancellation, etc. So you can always take that the time limit, though lapsed, you may take reference of the Honorable Supreme Court and challenge that particular orders or the proceedings and take it to the next level. Could you please confirm whether we can apply for refund on export of goods service without payment of tax under section 54, even if we receive the consideration in Indian rupees? Okay, as far as the goods are concerned, answer is was yes till the amended rule. However, the rule was not having a power which is coming only through this act. So if you are legally fighting, you can take it. Otherwise, there was no condition up to that time. Services are concerned, as far as services, it is an export of service as is set out in the definition, and it says export of services definition was amended to say either receipt of money in convertible foreign exchange or in INR wherever permitted. So if we are fulfilling that condition, we can still claim a refund in terms of section 54 being a zero rate supply in those cases for export of services. As per section 71AA, where the subscription fee collected by the advocate association from the lawyers is taxable. I am not seeing any exemption for the same as of now. We may have to make a representation now because similar sort of exemptions were there in service tax for any association or a bodies, etc. Where so when this section being made effective, probably we may have to ask for a exemption notification for the same. I am not seeing any exemption as of now. Will remuneration to partners be taxable now? My view, no, sir, not liable. To bullion merchants, how to manage the rule? I think I'll address this in a separate mail, whoever it is, for I think how to manage is a different question, right? Next, whether membership collected for residential will not be taxable when it happens if the single member collection is more than for a member. As it is Resident Welfare Association, there was an exemption on the presumption that it will be taxable. This provision, as per the understanding given, is always it was taxable. This amendment is sort of a clarificatory in nature. So whatever the exemption which was there would operate in the same way it was existing for the subscription. But the question here is what happens if single collection vis-a-vis club room charges for birthday party, etc., is more than some. That is an independent thing. It was never exempt and was not counted for 7,500 for a specific events. It was like a monthly subscription was only what was covered under that particular exemption per se. Next, we have two GSTR 3B due dates in our country, but how to claim ITC if a person from Hyderabad bought goods from there located in Delhi, who is liable on 24 date by fines being Hyderabad dealer. I think I'm not that much clear with this question. I'll address that in separately in the mail, no problem. How do we address them? Will they go to specific members, or how does it go?
So we'll share the questions to you, sir. We'll share the answers to all the members. We'll share the whole Excel sheet. Yeah.
Okay,
or else
fine.
if you want to be specific, I'll try to get it. So.
No problem, no problem. No, if it is there specific, I can put answer to specific. You can send it to them, no problem.
Sure.
The precondition of unliquidated is in return when the invoice enters IRN. Why should give stress on GSTR 122A? Sir, it is a policy. I have nowhere to comment upon it. Many of the decisions are taken like that. They want to ensure that the taxes are coming to the government exchequer. Next, that's over. 8th is over. In view of the lockdown, will there be an extension of last date for filing returns? We are expecting. We want to wait and see, sir. Section 16 speaks about the condition to entitlement, but it does not speak about GSTR 1 or 3B. Should be filed on or before due date. In this situation, what is the relevance of 2B to claim? I am completely in agreement with your argument. It is only guided by the guidelines or the methodology. 2A or 2B is not specifically set out, but only guidelines are there. Probably, I think, strictly speaking, going by the thing, it doesn't say anything of that nature that it should be reflected in 2B. That is where I was telling is the precondition to be appearing in the at the time when I'm taking a credit or later is a matter which needs to get confirmed on the amendment being enacted, whether rule 36.4 will be there in the statute book or not. Audit under any act isn't subject to reconciliation, whether it includes tax audit. Hopefully I understand the question correctly. Even though we are not doing an audit under the GST law, isn't it our responsibility to do a reconciliation under the GST to comply with an audit obligation in any other law? My understanding is yes, sir. Even though we are not doing a GST, we need to do a reconciliation for the purpose of ascertaining the correctness of the financial statements being audited by us. This is what I was telling before finalizing the audit. Let's do a reconciliation also. Will Amendment 51 covers ITC wrongly claimed remained unutilized in the credit ledger and revised later? I explained this in very detail. The amendment presently is only talking about delay in filing the delayed return being filed, and in that return, whatever the interest to be payable on that turnover declared, for that only the provision is being inserted. Others are left open to the interpretation. Next, sir, ITC being denied for non-uploading of GST on supplier, but so far as there is no late fee collected for filing GSTR 1, this leads to mischief by supplier. Why late fee not levied so far? The provision is there, but they have not made it active to say unless you pay, we will not accept the return. So it is there in the statute book to collect a late fee even for delayed filing of GSTR1. The assessee by mistake shown a higher taxable turnover due to the tax liability is due to discharge correctly. There is no provision for revision of 3B. The department was initiated subsequently. What are the production should be taken? This I understand is the same 3B. There was a turnover mistake, but tax was correctly discharged. You can always give a supporting documents for that and explain, and that would suffice, because any proceedings initiated, it is not the turnover alone required under section 7512. It's a tax liability assessed, not the turnover alone. See, tax is not assessed. Therefore, you always have a right to say that the tax is not assessed on the same. Dear sir, GST registration is cancelled and the application revocations cannot be filed now due to expiry of 90 days. How we're taking into consideration Supreme Court which says consequently the balance period of limitation shall be extended. Now we can make, obviously we can make use of this. Further, the latest update is the Honorable Supreme Court has further extended that date up to 15th of July 2021. So I think we can use this what a Supreme Court decision to make that application.
Yes, those were the questions.
Yeah, I think though I quickly covered for the facility of the time, surely I'll be addressing all those questions in the mail to be in a couple of days and circulated to SIRC, sir. Thank you. Thank you. Over to Chairman, sir, or Secretary, as the case.
Thank you so much, sir. Though we have given very limited time to you, you have prepared well and presented well. So thank you so much, sir. Almost throughout the session, 350 members particular GST session. With this request, Panaraj sir proposed a farm order of thanks. Panaraj sir.
Okay. Am I audible?
Yes, sir. Yes, sir.
Am I audible?
Yes, sir. Audible, sir. Please.
Yes, sir. Yes, sir. Please.
Yes, sir.
Yes. I think some technical
Issues. So you can propose vote of thanks. It seems he is disconnected.
Yes, sir. Yes, sir. So once again, I thank you so much, sir, for our excellent presentation, and you have shared maximum to the extent possibly within the time frame.
Okay. Sir, Rajesh.
Yes, sir. Audible, sir.
Thank you very much for your time. And especially when Shankar Narayan was not.
Chairman, sir, you can continue. I think his audio is lost. It's last.
Yes, sir. I think it's poor internet connectivity, sir. He's in home. So I thank each one of the members who are throughout the session, almost 350 members attending for this excellent program. So yesterday also we got around 400 plus members. So once again, thank you so much for each one of the members who are attending this program. And my personal and sincere thanks to Rajesh Kumar, sir. Already we have planned you for the next month. We have lined up, but because of that, Sangarnarans are not able to address today's program. We have invited you, but you have justified more than what we expected. So thank you so much, sir. Thank you so much. Good night. Good night.
I thank the entire SIRC team and the branch and chairman and secretary and all the participants for giving this wonderful opportunity. Thank you and all.
Thank you, sir.